Okay, so we kind of left off pretty close to this point here on the different types of mortgages. And I want to tell you that you're not going to find many of these out in financial institutions or banks being offered. The conventional, yes, you'll have a conventional mortgage. Um, Insured mortgage, they don't call it an insured mortgage, they call it an FHA or a VA loan. FHA stands for Federal Home Authority. Sorry, Federal Home Administration, and it's an agency geared towards providing housing for lower income people. There's a special need for that. And the VA, of course, is the Veterans Administration. Those are for our people who are retired or came out of the fighting forces in our military. They're part of the VA, and they can get a VA loan, which is when it says insured, that means that they are a secured party. A secured party is a technical term as who's on the loan. When you sign an application, you're the borrower. That's a secured party. The borrower is the secured party from the lender's perspective. The VA is not a borrower per se, but they're a guarantor in that the loan will get paid by the VA or the FHA, but there's some guidelines that have to be met, and you have to go through some certifications about the bank level to ensure that you're doing those loans correctly. There's a strict guidelines on the FHA and the VA loans, so not all banks will do them. And then the ARM, these top three are the only ones you're really going to find. Not a graduated payment mortgage. That's kind of complicated. And banks don't want to get into anything. It's complicated. Give me straightforward conventional loan. But a graduated payment mortgage or a GPM is where there's a high or a low initial payment, and they're increasing year over year for a 30-year loan. So every year you're paying more and more money towards the loan, but that accelerates your loan is always paid. As I said last time, in your payments, you're always paying more interest in the first several years, almost 20 years of a 30-year loan. It's mostly interest. You're paying mostly principal at the last 10 payments or 10 years, excuse me. Then we have our growing equity. The initial payment increases every year, and it's amortized in less than 30 years. So you are paying a little bit more towards principal, which means you're increasing your equity. What's the value, not the value of the home, the net value of the home, the market value minus any loans outstanding, which is this mortgage. Also, you might find second loans, but there's usually a whole different department that's dealing with second loans or second mortgages. And the reverse annuity mortgage or the reverse mortgage, that has become really a popular product. More recently, there are companies that just do that. And it's you're loaning money to your lender. The lender actually pays back a monthly payment to the borrower. That's that annuity payment equal to the value of the house plus some interest. And the balance increases that much until the house is sold, then they have a lien. And you never know exactly how much. And that's what I was referring to last on Tuesday, that reverse mortgages are great for older people who are alive, but once they die, that house, which was intended by the owners to go to a child or a grandchild or some trust, won't go there anymore because of the reverse mortgage. It's a way for elderly people getting money, regular money, because they didn't plan their retirement properly. On the other hand, this increasing balance is increasing a loan amount that will ultimately be put on and interfere as a lien in the selling of the property. That's the problem. So it's the survivors that are stuck with this loan, not the borrowers, which are the older people. It's very popular because the elderly do not care. Once they die, I don't care what happens to my house. It's up to you guys. And they don't really understand the financial part of it, the impact on the family when you do a reverse mortgage. Henry Winkler was one person that was advertising that at one time, and everybody thought Henry Winkler was cool. Even as an old age, he's just a nice guy. So I really feel badly for him for the way he's portraying reverse mortgages and what really is the underlying problem. So this chart here shows the different players in the mortgage market. Federal agencies, about 45%. Banks and savings and loans is what SNL stands for, savings and loans. That is no longer a true term for it anymore, but we'll throw it out there. We'll just call them banks, life insurance companies, and mortgage trusts. A mortgage trust is an interesting kind of vehicle. You would invest in the trust, or you put up a bunch of people put up their money together, and out of that money, you lend it out. The money is not insured. You're a lender, but you're not regulated. But like other banks, you're not a bank. A trust is not a bank. So as the loan payments are coming in, the money is distributed to the investors. So you, Juliana, and Alex, you put $100,000 into a mortgage trust, and I borrow $50,000 as a loan against my house. Well, every time I pay a payment on that $50,000, and the trust administration is the one that determines what that interest rate's going to be, kind of less than what market will be because there's no other costs. And both Juliana and Alex, you're going to get a portion of that interest payment back directly to you because that's part of the money you're that's the reason for the investment, is the return. And that interest rate, every time I make a payment, you're going to get a portion of that interest payment interest only portion of that payment. So that's kind of why people will go into a trust. The interest rates are lower. The credit criteria, the 5 C's, are scrutinized differently than in a bank, and they're not regulated. So because they don't have regulations, they don't have to meet any kind of standard. They have their own standards they're going to keep. A little loose, and the trust is beholden to the trustors, the people that put the money in, not the borrower. So there's no protection for the borrower on that respect. But they exist. And mortgage pools and trusts, a portion of this was carved out in 2005, calling themselves the shadow bank. Shadow banking became very similar to these mortgage trusts. They just call themselves a bank, but they weren't. They weren't regulated. Solomon Smith Barney was one. There were several at the time. By the time the financial crisis happened, there were a bunch of these mortgage trusts or loan trusts that called themselves banks. Mortgage servicing is another term. We have 2 sides to the mortgage. There's origination, and then there's servicing. Up to this point, we talked about origination, the 5 C's, collateral, interest rates, and then once it's originated, the servicing is processing payments and also packaging the loan to be sold. Here's a little trick what happens in the mortgage industry. Banks do not hold those mortgages on their books for the entire 30 years. Think about this. Really think about this. Alex, how long would it take for you to, how long would you are willing to wait for your money? You give me $100,000. How long are you willing to wait for it?
I mean, it depends if if I plan on keeping it in there for a long time.
I mean, you loaned it to me. How long you want to wait for me to pay you back?
Oh, maybe like a couple of weeks.
A couple of weeks. Well, $100,000 is going to be harder for me to come up for for a couple of weeks.
Yeah.
But you won't wait for me 10 years, would you?
Yeah. No.
No, you want your money sooner. You're not going to wait 20 years.
Yeah.
No, you're going to wait 30. You're not even going to wait 30 years. You wanted it in a couple of weeks.
Yeah.
So I'm not borrowing money from you. Even if your interest rates are low, I'm not borrowing money from you. Mark that down. Do not, could Juliana hear that? Do not borrow money from Alex.
All right.
You got it? Okay. All kidding aside, you're right, Alex. And even banks are that, I wouldn't call it impatient, but that's realistic. Why wait 30 years for $100,000 to be paid? It's good for the borrower. It's good for the spender side, but from the lender saver, you want your money sooner. So that's where the loan servicing selling part comes in. So let me put that, just write down those parts. So points are really, one, we have the origination part. Two, we have the loan servicing part, the mortgage servicing part. And three, the secondary market. Can you see that? Oh, hold on. I'll do this. There. Mortgage origination, we've up to this point we've talked about. I'll briefly talk about servicing very quickly, and the rest of this class time we're going to talk about the secondary market more. So the mortgage origination, it deals with the 5 C's, surveys to determine the actual property lines, appraisals to determine the value of the property and the collateral, credit investigation, credit reports, and titles to make sure there's no other legal obligations or anybody having a claim against the property, legal claims against the property that have been filed. Those things are all to ensure, or what we call perfect. It's spelled perfect, but it's pronounced perfect, to perfect that lien, to ensure that no one else can do anything with that lien once you file it against the mortgage. I mean, the mortgage against the property. Mortgage servicing is simply ensuring that the payments are coming in. And once that is established, then there's goodwill. Now, in addition to loan servicing is ensuring and packaging that loan into a vehicle that can be then sold on what's called the secondary market. Now, secondary market is, we've talked about that a little bit. The stock market is a secondary market. The bond market is really a secondary market. And the mortgages are a secondary market. Okay. And mortgages are secondary market. The secondary market is, another way to think about it is, at the point of origination and closing, who gets the money? Well, the borrower gets the money, right? And the bank has spent the money. Well, in the secondary market, the initial person who got the money is not involved in the transactions anymore. Now it's the person who is looking for their money. So the mortgages are sold. It does not immediate. By federal law, banks have to keep that loan on their books for 30 days before they can sell it. And they sell it. When we talk about a sold loan, it's principal plus some interest that the lender is going to get. And then it transfers hands to the next lender. So Alex lends me $100,000 for 10 years. This time he's going to wait for his money, but he really doesn't wait for his money. He goes to you, Juliana, and say, Juliana, I have this, Professor Matthews owes me $100,000 and he has 10 years to pay for it. But if I sell it to you, will you wait for Professor Matthews? I don't want to wait any longer. I've paid for 6 months. And she says, sure. So I've made 6 months of payments, which means I still have 9.5 years to pay this loan. So she has to, Juliana, you're going to have to sit on it for 9.5 years. Well, in 9.5 years, you will get the $100,000 back, plus all the interest I owe from day one, right? So Alex wants to get his 100,000 plus a little bit because he sat on it for 6 months. So you're actually going to pay a little more than $100,000, Juliana, and you're going to take over the loan. That's where the saleability comes in. And then, Juliana, you go to Catherine, who comes in later and says, hey, Juliana, how you doing? You say, Catherine, I'm fine, but Professor Matthews borrowed money from Alex, and I have this loan Alex sold me, and I don't want to wait any longer. It's been a year and a half, and he still owes money on the loan, and I really don't feel like sitting and waiting for it for 18 more years. So Catherine says, I'll buy it from you. Now, she's not going to give you just 100,000. She's going to give you more than that, because actually whoever holds or left holding that note at the end will collect 100% of all that principal and interest. So they're paying for the right. Plus there's a charge. You're not going to get full amount because you're not holding it for the full time. And that's kind of how this mortgage industry works. Now, sometimes the bank will retain the servicing part, even though the loan is sold. So what's happening is I still pay Alex. Alex sends the money to you, Juliana, or in this case, Catherine, because she was the next person to buy it. So Alex finds out that, Juliana, you sold it to Catherine. Alex is the loan servicer. So I keep paying Alex, no matter who owns the loan. I keep paying Alex. Alex is going to send the money to Catherine, and Catherine's going to do whatever she wants. But that's the principal and the interest payment that I'm making through Alex to Catherine. And that's what this is saying here. The servicing agent handles the paperwork. Servicing agent also may be the first seller of the loan or the original lender. There's been more and more e-businesses or online businesses that are offering loans. Lending Tree, I think, is one company that helps you shop around for the best rate for you for whatever. They solicit rate information from various banks in your area. You put in some criteria and say, this is what I'm looking for, and they try to find that. That's not the same as a borrower itself. They're just an agent helping you look for one. But there are businesses that have tried to set up doing online lending strictly. It doesn't work very well because there's a lot more regulations and it makes it very difficult. So another way of talking about the secondary market is securitizing the loan, meaning that you pool like type of loans together and then sell them at a certain premium. That's what this MBS stands for. MBS, you see, this is called a mortgage-backed security. Pools hundreds of loans together, ensuring that the amount of cash flows are flowing out towards the ultimate investor. It was pretty simplified. It was pretty simple, and it was a big deal in the 80s. Back in the 80s and 90s, we were all over MBSs. Unfortunately, it became more and more complicated, and it got less and less secure. It's secure in that once you invest in it, you're going to get that money. The thing about the MBS was that MBSs were packaged at the point of the lender. And if the lender pretty much halfway did their C5C investigation in the origination part, then the quality of the loan the risk level is higher than promoted. The risk level would be quite high if you didn't do all the work. What you're supposed to be doing, you see. So you have loans that are not as prime, so they are subprime. That's where the subprime mortgage term came into being, is that prime loans were loans of a particular type of person with a long-standing tenure at their job, cash in the bank, a very good collateral value of the borrowed, I mean the home. All those things were very good. Good credit, pays their bills on time for years and years, have good old credit. You, all that would be considered a prime lender. But more and more by the 2005, 2006, 2007, banks were reducing or lowering that criteria so that they can get more loans, which then they sold. But what they didn't tell anybody was that these loans that we're making for the less prime borrowers, the subprime borrowers, were being packaged within the MBS. So what happened is that, and look at this statistic. By 2009, the MBS market was at $8 trillion. And that kept going and going. What happened was that the MBS, inside the MBS was some clunkers, some subpar loans, and all of it was sold as prime loans. That they're all great people, but there are several deadbeats inside there that nobody knew. And they really didn't exist even at the time of application. They existed because of the economic downturn and the financial crisis of 2007 and 9, 2007, 10, and this is just prior to that. The borrowers were not making enough money, so they stopped paying. When they stop paying, the MBS stops paying. And the MBS stops paying, what happens to the investor that bought the MBS? They're mad. And that's where the snowball, the domino effect starts to happen. And they didn't tell anyone that they were bad loans, or even part of it was bad loans. The banks lied. They hid the truth. They hid the truth about the MBSs and falsified, I put that air quotes, falsified the documentation to say that these are good loans. Maybe a few, but not all of them. There may be a few that were bad, but the bad ones spoiled the rest of it too, and the entire MBS vehicle was spoiled. And it was the investors, the savers that bought that into that were the ones that were hurt the most. GNMA stands for Ginnie Mae. That's just a name that they call it. It's Government National Mortgage Association or Administration, something like that. I forget what Ginnie Mae stands for. But it's sort of like a government agency that it is where and they're the ones that the secondary market starts with Ginnie Mae, and they pay the banks, buy those loans from the banks, those MBSs. Starts there. You can invest in Ginnie Mae or in a mutual fund that invests in mortgage MBSs. You could. Now people are very, very apprehensive of getting involved with that. Ginnie Mae currently is still under receivership because they went bankrupt buying these bad MBSs from the banks and didn't know any better because the banks were saying that they were great. Look at this top sheet of all these great people. Don't look at the back or the further on where you can see all these bad people. Just look at the list of good people we have in this MBS. And hence you've got the problem. Then MBSs were sold and they were cut up into smaller pieces called tranche. And the CDO, collateral debt instrument, or collateralized mortgage obligation, that's what the CMO stands for. And it's basically they took the loan, cut them up into pieces, taking out of that MBS, which was several loans, and making smaller pieces of it. So they cut up the MBS into smaller pieces, called a tranche. The tranches then were sold as separate investment vehicles, not so much an MBS, but as further investment vehicles. So the buyer of the MBS gets some of that money back right now. You see, it's all getting my money now, not waiting and waiting. Freddie Mac or FMAC, FLHLMAC, um, did also got involved in these CDOs and MBSs and got in trouble, and was also now in the receivership because of it. Some commercial banks will do it too, but people are less apt to do it through a commercial bank because commercial banks are private. Ginnie Mae was considered the government. Freddie Mac was part of the government. Fannie Mae is part of the government. Fannie Mae deals with student loans. I talked about the subprime mortgage. Subprime loans are loans to borrowers who have poor credit ratings or other issues with collateral. 2% of all mortgages were subprime. By 2006, 17%. Mortgages that were hailed by politicians and bankers alike. They helped less than perfect borrowers secure the American dream of owning a home. And since real estate prices can't ever go down, there is a little risk involved. Yeah, right. That's what happened. The prices started going down. We could talk about the real estate bubble, but these bubbles all added to a particular crash. Between 2000 and 2005, home prices increased about 8% a year. And it was caused by, one, an increase in the number of subprime loans that were being issued or funded. And the people that got the loans were buying these houses. So the supply started to dwindle, the prices started to go up. And real estate speculators also caused the prices to go up. In 2006, CDOs were 520 billion. In 2009, it was 4.2 billion, and increased in 2012 to 58 billion. I'm sorry, that's 520. Excuse me, I read the number wrong. 520. The CDO peaked at $520 billion and fell to $4.2 billion and now up to 58, or not now, but it got up to 58. It's the same thing, meaning it's the same vehicle, just people were getting in and out of it. So what are mortgages? They're loans made to purchase real estate. They have mortgage, there's a length or a term, the legal terms in the loan contract, rate changes if there are any, if it's an ARM. We talked about conventional, insured, fixed, variable, or ARMs. We talked about different other institutions, not just banks, but I worked at a bank for a long time. For a number of years, I worked in a bank in mortgages. That's why I know what I'm talking about, in that I know how that worked with in timing wise. And then we talked about the secondary market. I think that's it. Told you it'd be fast. How was that? Any questions?
No, I don't have any.
Alex?
No, I don't have any.
Okay, let's do it. I did not post I'm sorry, I forgot to post the mini case for this week. I will post that in a little bit, hopefully before 4. Wait a minute. It's almost 4, right?
3:50.
Yeah.
Okay. The clock in this room says 5, so I just want to make sure I was right. All right. Let me stop the recording.
All right.